Great, thank you. Yeah, I think I'll be talking a little bit about market trends happening in this universe. I think I'll connect it, especially at the beginning, to what Peter was saying. Talk a little about kind of like the flows of funds that are going in, the size, the vehicles. Talk a little bit about the drivers, and yeah, hopefully kind of at some point bridge it to the discussions we've been having already. So the first slide, please. Just to kind of give people a sense of what we actually expect to happen. One thing is an aspiration. This is like a forecast of what we expect to happen given current policies in terms of kind of what's going to get built in terms of new electric generating capacity around the world. You see that already the world is going to be shifting towards much lower carbon sources of energy on a business as usual basis. We'll be adding two-thirds of what we add will be renewable energy capacity globally. If you go on to the next slide, please. You see just the amount of investment that's going to be required. Again, this is just business as usual. You see on the order of $7 trillion of investment between 2014 and 2026. Again, very, very shifted towards Asia, and you see that most of it is actually going to be in the form of renewable energy. And so, the numbers that Peter gave in terms of kind of total investments that's going to have to happen on the order of $1 trillion per year in clean energy, we don't expect that given current policies. And so what you'd actually need to see is a major shift in policy, a major shift in investment trends already underway for that to be realized, which is not, this clearly shows a much more bullish view of renewable energy than most energy forecasters are predicting, but clearly it's not sufficient for the kind of climate goals that we're aspiring to. And the titles of the slides are always at the top, and I see that it's being cut off. So I'll try to kind of remind people what the title is as we go on. So this is total investment in new electric generating capacity. Just to kind of put things in perspective also, these numbers for APAC, a lot of the APAC is Asia Pacific, which includes China. We are already projecting on a business as usual basis that China will add 900 gigawatts of zero carbon capacity. 900 gigawatts is an extraordinary number. It's basically almost the entire U.S. fleet. So China between now and 2030 will be adding essentially the entire U.S. fleet just in zero carbon between nuclear and large hydro and renewable energy. So clearly already a shift is underway in China, and China by far exceeds any other country in terms of renewable energy getting built, in terms of investment funds that are going in. But that's clearly not sufficient for the kinds of targets we're talking about. Next slide, please. This slide just starts to get a little bit of the drivers. And what we're talking about here is just to get a sense of the module price declines for one technology. This is solar. This is the fastest growing technology and the one that's where the costs are coming down most quickly. What you see is that so far the actual price points for solar modules, whether they be crystalline silicon or thin film, have actually held up pretty well to the experience curve. Next slide, please. And what does this mean? What does this experience curve mean in terms of the economics of solar? On the left-hand chart is 2014, and the right-hand is 2025. The x-axis in each case is how much solar radiation a country receives, how sunny it is essentially, and the y-axis is the retail electricity price. And so a country like, for example, or a region like Hawaii has very high electricity prices and very high installation. That's why it's in the top right of the chart. The size of the bubble is how big the market is. And essentially, the curved line, the curved purple line is the levelized cost of energy for solar. And what it means is that if the levelized cost of energy falls below where the bubble is, it's economical to be doing residential solar in that region. And you see that this is all unsubsidized, by the way. And you see this already many regions of the world where it is economical to do solar. But forget about today. Let's look just 10 years ahead to 2025. And you can see that almost everywhere in the world it will be economical to put solar on your rooftop. Next slide. And then a last slide, just thinking in terms of the drivers. This is a survey. We didn't conduct this. It was another organization that conducted this. They conducted a survey of 400 utility executives at U.S. utilities, where they asked them about what they see in terms of what the future of the utility is, what the opportunities are, what the challenges are. First question, what does your utility see as the biggest growth opportunity over the next 5 years? And top of the list is distributed energy. And then second question is, what are the top 3 emerging technologies in which to invest? And all the way at the top is energy storage, and among the top 3 is utility scale renewables. And then just a quote from the chairman of NextEra when they purchased the Hawaiian utility late last year. calling the acquisition, they refer to it as say that Hawaii is essentially a postcard of the future of what we expect to happen in the U.S. And so if you think about the charts that I showed earlier about what's happening with solar energy economics, you look at these charts that basically kind of say what utilities are thinking about in terms of their growth, and it's clear that already a shift is underway among the people in the industry towards a grid that's cleaner, more resilient, more flexible, essentially the grid that we probably aspire to have. So already just to kind of give you a sense of what those market trends are and what people are thinking. Next slide. I have 20 slides in total, so we're making progress. In the U.S., just to give people a sense of what's happening, you see that in terms of what we're actually been building in the U.S., we're essentially building at this point only natural gas and renewable energy. This chart is current up to 2014, and if you were to see the projections for 2014 and 2030, you'd see just a lot more of this, more renewable energy, more natural gas. As a country, we're basically done building coal, and at this point, we're looking at the retirement of coal capacity already. And there's regulations that are going to be biting this year. We're going to see more than 20 gigawatts of coal get retired this year, and then on the order of something like 60 gigawatts that have either been already retired or announced to be retired, and that's just announced. Obviously, we expect a lot more to be retired just based on how the economics work. So as a country, we're already shifting towards a lower carbon grid. Next slide, please. Total investment going into clean energy. So let's talk a little about the numbers into investment. We had a peak year 3 years ago, more than $300 billion invested. It dropped off for the last 2 years, and now we're back. We're back up close to a record high, $310 billion invested in clean energy. Clean energy, we mean renewable energy, digital energy, some energy efficiency investments, energy storage, electrified transport. We don't include nuclear. That's just kind of where our definition ends up. But you can see what the trends are looking at here. And then if we go to the next slide, you can see what the regional mix is. U.S., $52 billion of that. China, close to $90 billion of that. And really, it's China's been leading the way. And these numbers obviously rise and fall in a given region depending on what the policies are. But increasingly, the policies are going to be less around the subsidies and less around the incentives and the subsidies, and much more around the actual economics of what makes sense. Next slide. Just understand where's those $310 billion are getting invested. Here's the breakdown of how we come up with $310 billion. The 310 is the big column close to the left. We don't include the ones all the way to the right. Those are not new investments. So where does the $310 billion comes from? A very small part is venture capital and private equity towards the left. There's some portion of it which is R&D funds. And then you actually see that most of the $310 billion is renewable energy AF. That means asset finance. That means investing in very large projects. Last year, it happened to be very large solar projects, very large offshore wind projects, very large solar thermal, concentrated solar power projects. That increasingly the future will just belong to large solar and large wind. But the most important component, in terms of kind of how fast it's growing, is SDC. That's small distributed capacity. That means essentially rooftop solar. So those are the big categories. You see there's also a component for public markets, new investments in the public markets, whether they be IPOs or secondaries. Next slide, please. Just to give you a sense of the equities story for clean energy stocks. This is the NEX compared to some benchmarks. The NEX is an index of around 100 companies globally that are active in clean energy, and you see that the NEX has had relatively good returns over the last few years. Underperformed last year has been, in general, the way our CEO describes it is that the NEX is when there was a bubble, it was bubblier than the bubble, and when there was a crash, it was crashier than the crash. Next slide, please. And so just to kind of think about the evolution of financing, and this is the example here is solar energy financing in the U.S. And the left-hand chart, the left hand of the slide shows how we used to invest in solar in this country, and the right hand shows how we're starting to invest in solar in this country. And you see that in the past, it's really been, the banks have been very important elements of it. It has tended to be relatively illiquid investments, long-term debt offered by the banks, or in some cases, insurance companies. And now on the right, we actually see that there's many more players that are involved. The assets can potentially be more liquid. There's the potential to use vehicles like Yieldcos, and we'll talk a little bit about Yieldcos, or green bonds, or securitization, vehicles that essentially open up these investments to the capital markets in a very big way. And of course, when you open that up, you get much more participation from the hedge funds and the pension funds and institutionals. So this has been a very important development and it's already starting to happen. We're really seeing a maturation of who invests and how to invest in this example in solar energy. And as a result, the cost of capital, of course, declined. Used to have relatively high cost of capital. Now, if you're investing in a solar project, a relatively mature project, even when it's kind of close to commissioning, the returns you're looking at in the U.S. on the equity side might be 6 to 7%. If it's debt, maybe it's 5.5%. Some of the securitizations that have happened have been around that range. Next slide, please. Just to kind of give you a sense of the public markets activity with solar, we saw that of the IPOs that have existed in the U.S., they used to be manufacturing companies. And increasingly, the IPOs that we're seeing in the U.S. are not manufacturing companies. Rather, they are developers or installers or financiers, or especially Yieldcos. Basically, thinking about when you're investing in a renewable energy stock, in the past, there might have been investments around manufacturing, around equipment. Now you're investing potentially in companies that give rise to assets or in assets themselves. And that's essentially what a Yieldco is. Next slide, please. Yieldco, important phenomenon. It's a publicly traded company whose main purpose is to hold operational assets. And so this is, if someone's interested in equities, interested in the renewable energy space, interested in kind of a dividend yielding asset, this is probably the right kind of an approach. Next slide, please. And just the picture of these Yieldcos. These are the key North American Yieldcos that have emerged. You see what the assets are that they contain already. They're mostly renewable energy assets. And you see that there's an arrow for each one of them, and with one exception, it's TransAlta. But for all these others, there's an arrow basically indicating that they intend to acquire more assets. And so in that sense, they're not just about kind of producing a steady stream of dividends. There really is an aim to appreciate the share price. Next slide. Green bonds, Peter spoke about this. It's a very important development. $39 billion invested, huge increase from previous year, more than 2x increase. Huge level of interest in green bonds. These $39 million don't necessarily overlap with the $310 billion I showed at the beginning, because a lot of these you consider refinancings. But it does show that, and I very much agree with what Peter was saying, that it does show that companies are inclined to offer these. The level of interest has been very high. They tend to be oversubscribed. And this doesn't even consider, these are just market labeled green bonds. There's an entire universe of green bonds being offered up by clean energy companies that don't explicitly get labeled as green bonds. Next slide. Green bonds, just to show you what that mixes look like by sector, by region. Next slide. And this is just last two slides. They've asked me on the panel just to give me a sense of what green means. These are the 5 categories we use when we're doing the green bonds tagging on the Bloomberg terminal. 5 different categories: renewable energy, what we call energy smart technologies and energy efficiency, green buildings, ag and forestry, and then other sustainability related investments. And so for it to be a green bond, there needs to be kind of explicit use of proceeds that are linked to these activities. And finally, the last slide, Sister Pat was conscientious about saying that this isn't about divestment, but just to kind of put the divestment picture in context, it really is a challenge when you're thinking about fossil fuel divestment. Why is that? Fossil fuel, for a couple of reasons. One is size, 2 is liquidity, 3 is yield. When you think about the fossil fuel universe, just in terms of size, we're talking about $5 trillion in market cap for the oil and gas companies and the coal companies. Now, this was before the oil prices collapsed, so it's obviously a little bit lower now. But there really isn't anything comparable right now on the clean energy side. So there's nowhere we could find a place to invest $5 trillion if we wanted to divest all of them right now. You look at these other industries, what you're seeing here is the yields, and nothing really that offers comparable yield. There are some that offer comparable yield but not comparable size, or some that offer comparable size but not comparable yield. And so at this point, it's hard to kind of think about that $5 trillion chunk as a whole. maybe if you broke it up into coal and oil and gas, and obviously the coal ones is a $250 billion market cap, and there it's kind of much more tenable to kind of think about what would happen with those investments. And that's it.